All right. So thank you everyone for joining us today. This is the Common Single Audit Deficiencies webinar and hopefully how to avoid them. My name, just for those of you who don't know me, my name is Kurt Schlicker. I am out of our Reno, Nevada office in the firm, and I know many of you are across the country. There's my contact information for whatever reason. If we can't get to a question that you have during this presentation, or you think of it afterwards, or need additional clarification of any kind, I promise I don't mind at all. I'll be happy to respond to any questions. You can email me or call me, and just feel free. Okay, so kind of a background of what we're going to be talking about today. Many of you on the line, there's a broad background of grant managements for your organizations. Some of you maybe are involved with grants that aren't super complex. Maybe they're just payroll and you submit a report to your pass-through entity to get reimbursed, and it's generally straightforward. Some of you may be maybe in a more complex grant environment where you have matching requirements and level of effort and a lot of subrecipient monitoring, or maybe a lot of special tests, a lot of complex federal requirements and regulations may impact each and every one of your grants. So because everybody's kind of coming from a broad background, we're going to go through all the major compliance requirements, and I'll try to give at least a little bit of a background of each compliance requirement. Many of you may not know what matching or level of effort or subrecipient monitoring is because you just don't deal with that in your organization. But I'll try to give a little bit of a background on each requirement, and then we'll discuss the common findings that we see during the audit, and then we'll talk about how to prevent those common findings, because I think that's hopefully what everybody is here for. I wouldn't be an auditor if I didn't at least have one or two slides on internal controls. Before we really get into the nuts and bolts of all the compliance requirements, I just want to talk a little bit about internal controls in general. You're going to see probably on almost every single compliance requirement, the prevention is implementation of internal controls. And that's because from a broad perspective, what we're talking about is documented review or review not detecting errors. We have, there's lots of policies and procedures out there where somebody has to review a report or review an invoice. But just because there's a signature or review initial on the report, if they're not actually performing the review and it's just something perfunctory that they do because it's in their policy, then that isn't effective. So when we're really talking about internal controls, we're really keying in on what kind of review process is there, and is that review process effective? Obviously, for some organizations that don't have a large staff, having segregation of duties and a separate review process may be challenging. So we can talk about different types of internal controls in those situations where it might not always have to be segregation of duties and review, and we'll address them as we come up to individual compliance requirements. So again, just some overall comments on internal controls. Here's the federal definition. I'm not going to promise I'm not going to read this whole thing to you, but the big picture item is that the controls provide for reasonable assurance to ensure that transactions are properly recorded and that the funds are safeguarded. So if we just think about that reasonable assurance, controls aren't going to catch collusion, and they're not going to catch a lot of fraud, because that's how fraud and collusion work. They bypass internal controls. But assuming that we're not dealing with a fraud or collusion type, scenario, they should hopefully catch all material, non-compliance or material errors, and then they should hopefully catch most of the smaller ones. Again, reasonable assurance. It doesn't have to be perfect, but it needs to be reasonable. The bottom bullet point, this is kind of more of an information for you all, because I have a lot of clients that aren't really aware of this. But when you agree to accept federal awards, in the Code of Federal Regulations, you also agree to maintain internal controls. That's actually a prerequisite and a requirement to accepting federal funds. And that is sort of literally the basis for the single audit. So many of you may be thinking, you know, we get findings from Eide Bailey or other auditors if you're not a client of ours, and they seem really ticky-tack sometimes. You know, it's not like there's $100,000 that were spent inappropriately. It's a $1 million report and you guys found a $2,000 error. Trust me, we agree. We know that a $2,000 error on a $1 million report is not some material, you know, error for the grant. But as part of our audit, we have to look at the effectiveness and the functionality of those internal controls. And this would be a case where the review didn't catch an error. And so that's where an internal control finding comes. It's not a material noncompliance to the grant, but it is an internal control finding. And that's because we're required to test that as part of our single audit. So now really getting into the various compliance requirements. So allowable activities and allowable costs. I think almost every single grant has this, so hopefully all of you are familiar with this concept. But auditors, we generally break down allowable activities and allowable costs into 3 different, you know, areas that we kind of hone in and focus on. One is payroll, so that's, you know, compensation, whether they're salaried or hourly employees. That also includes fringe benefits. There's indirect costs, and then there's direct goods and services. And that's really the 3 areas that we break costs into. Each of them have specific requirements, right? The way we audit payroll is different than the way we audit indirect costs. But there are some general basic considerations that impact all of them, and we'll go over them on the next slide. Most of this, or all of it, is coming from what we call Uniform Guidance, Subpart E. So Uniform Guidance is 2 CFR Part 200. That's Title 2, Part 200 of the Code of Federal Regulations. And then in Subpart E is where the cost principles are, and the generic cost principles are in, you know, specifically 200.420 to 200.475. General factors that doesn't matter whether it's indirect costs, direct costs, payroll, compensation, fringe benefits. These are some elements that impact all of them. The first and foremost, if you get anything out of what's important for allowable activities and allowable costs, is the costs need to be necessary and reasonable for the administration of the award. So what does that mean? That means that the cost has to be supporting the grant program. It can't be something that's completely unrelated, and that the actual cost itself has to be reasonable in price, right? So maybe you're paying some supplies expense and you're buying paper for your grant. That is necessary, and assuming you're getting it at a reasonable price, that's all fine. But if for whatever reason you're buying, you know, super paper that's 15 times the cost, that may not be necessary and reasonable. Has to conform to any limitations or exclusions. We're going to go through a few of these on the next 2 slides, but in that previous slide where I said those generic cost principles from 420 to 475, that's where there's some limitations or exclusions. So depending on the type of cost that you have, there may be some factors that impact the total allowability of the cost. This is a big one. This next one is be consistent with policies and procedures that apply uniformly. That means your procurement policies. We're going to spend quite a bit of time on procurement suspension and debarment later in the webinar, and I'll talk about this some more, but this is really key, that you have to purchase and buy goods and services, or even, you know, payroll. They need to be consistent with your policies and procedures, and you can't vacillate and pick different policies and different procedures so that you're not purchasing things consistently, or you're not paying payroll consistently. It has to be consistent and uniform. It has to be determined in accordance with GAAP. The next one, also key, You can't double dip. I'll talk about more double dipping once we get to matching, but it can't be included as a cost for another federally financed program. So you can't use it as get reimbursement from your program and then also use it as a matching consideration for another program. That's unallowed. And then the big one that the auditors look at is it has to be adequately documented. If you don't have a record of the invoice or the cost, it's really hard for us to say that it was necessary and reasonable and that it complied with all these other factors. So here I've got on this slide and the next slide a couple of common findings or items that come up. Some are common and some I just put in for more informational purposes on types of unallowable costs that we see. So the first one, alcoholic beverages. I think that's obvious to everyone, or hopefully, that purchasing beer or alcohol for an event is not allowable under a federal award. But one that may give you guys some pause is if you think of grants that provide meals, and maybe there's some senior assistance type grants where seniors go to your senior center and get free meals. We have had clients that buy wine. The chef purchases wine to build into the sauce, right? They're making some sort of spaghetti sauce and it's got wine in the sauce, and questions have come up, well, is wine allowable when it's used as a as a cooking ingredient, and the meal actually is what's charged to the grant. So unfortunately, alcohol, no matter the purpose, is unallowable. So it's not always obvious, like your grant manager couldn't charge beer to the grant. It can be those ancillary type things that you didn't think about. Audit costs. Audit costs are allowable. The trick with audit costs is that they have to be reasonably proportionate. So you can't just charge the entire cost of an audit to one grant. You need to allocate it in some sort of reasonable and consistent manner. Again, it just has to be reasonable. It doesn't have to be exact. Normally you can get some sort of allocation from your auditors, but you can choose to get audits reimbursed. It does have to be a single audit, so you can't get a financial audit allocated to a grant program in most cases. Sometimes it can be part of indirect costs, but it just depends. So there are some specific rules for audit costs. Bad debt. We have had clients that try to charge bad debt. It does show up as an expense line item in your GL. Bad debt is not allowable. The feds don't want anything to do with how good or poor your collection process is. So that's not an allowable expense. Bonding costs are generally allowable. They're generally included in your indirect cost pool. There are some specific rules. They have to be necessary and reasonable for the program, or like your general bonding costs for the organization as a whole. If they're excessive bonding requirements that exceed the federal limits, then the portion of those costs wouldn't be allowable. Contingency funds. We see contingency a lot. I think you all probably see contingency a lot. That's only allowable from a budget line item perspective. You can't actually charge and ask for reimbursement under contingency. What happens is you have the contingency budget line item, and then when you see a need for it, you apply for a budget augment to get those funds reallocated to what they actually are, whether it's payroll or construction or contracting, whatever it is. And then once the budget is augmented and reallocated, then you would apply for reimbursement under those actual costs. And you can't apply for funds just based on the contingency line item. So that's unallowable. Donations are unallowable. Depreciation. Depreciation is allowable, but there's a key here that the original cost of the purchase of the equipment or the building, the real property, whatever it was, couldn't have been charged. So there's a couple of reasons that some entities may do this. Sometimes you're looking at your grant budget and you don't have enough available funding to, purchase whatever vehicle or equipment that you want, but you still have a need for that vehicle and you would like to charge it to the federal award. You can purchase that vehicle and then not charge that original cash price because you didn't have enough funding left on the award, and then charge the depreciation over the next 5 or 7 years, assuming that it's an ongoing grant, to the federal award. Entertainment is generally not allowable. If you do charge entertainment, you need to have had prior written approval from your grantor, and it needs to obviously serve the grant purpose. Fundraising, for a lot of you nonprofits on the call, I know we have quite a lot of nonprofit participants. Fundraising is generally not allowable, but if you're fundraising to support the programmatic objective for whatever your program is, those costs could be allowable as long as you have prior written approval. So I know, sometimes nonprofits are looking to maximize their reimbursement and their costs. That could be a way. Again, you need prior written approval and it needs to be for your programmatic purpose, but that's just an example of some costs that you can recover. Interest. We get questions a lot on whether interest on financing or, like leases or on a line of credit, those type of things, are interest allowable. So interest is generally not allowable unless it's related to the financing for the construction or purchase of capital assets in relation to the federal award. So if you're building a building to support the program and you need to finance the purchase of that, interest costs can be allowable. There are a lot of calculations that go into that, a lot of cash flow calculations. So this would be an example of, conforming to those limitations or exclusions. If you think you can charge interest, I encourage you to read through the cost principle over interest and go through the cash flow calculation to see if it's allowable. Memberships, we get this a lot too. Can we charge the membership of some group that we're a part of? If that group is like a business or a technical type group and it's a professional group towards the organization or towards their grant program, yes, those can be charged. But if they're social membership groups, or angel investor membership groups, those aren't allowable. So again, limitations and exclusions there. Participation support. Participation support is allowable, but you need prior written approval. You'll notice on a couple of these I've said prior written approval. So where does the finding come in? The finding comes in by not having that prior written approval, and that's what we see. Participant support is, I'll use my earlier example with like a meal program for senior citizens. Maybe the meal program is the grant award, but there's some difficulty for transportation for those senior citizens. And so as a participant support cost may be to pay for taxi cabs or Ubers or Lyft or whatever to get some seniors to the senior center. You could theoretically apply for written approval to have participant support costs be allowable to get the individuals to the meals if it's not already covered under the grant. Professional services, of course, these are allowable. We're going to talk a lot about procurement suspension and debarment. That's where we'll run into issues with professional services. Proposal costs, yes, these are generally allowable, and it doesn't matter whether you are successful or not in proposing for new federal awards. The trick is, though, that this is generally an indirect cost that then is allocated. It's normally not a direct cost, because if you're unsuccessful on a new federal award, how do you directly charge that to a different federal program? It's more of an organization-wide type cost. Recruiting and relocation, these are allowable. So if you think about it, if you're a university and you have somebody high up like the president or director of financial aid, or somebody leaves and you need to go into more of a nationwide search to get somebody qualified. There are relocation and there are recruiting costs associated with that. Those theoretically are allowable, but there are exclusions, so please read through them. They're not just blanket allowable, they have to be reasonable. Taxes, I mean, if we think payroll taxes, those are allowable. Some other taxes are, some aren't. So it's key to understand if you are charging taxes other than payroll taxes to the grant, what exclusions there are. And then travel, as long as it's for the grant and you know, you're not flying first class and it's not unreasonable, then travel is also allowable. And I know I went, oh, we're coming up to a polling question in 1 second, but I know I went through those a lot. Those were really just examples to kind of highlight the different types of general, just the different types of general cost principles that are out there. There's over 50 of them, and I listed 18 of them. I encourage all of you to look at subpart E of uniform guidance and go through and just see which costs may apply to your organization, and see, are there costs that you can recover that you haven't been asking for reimbursement for? Are there costs that can be in an indirect cost rate pool that you haven't considered before? Or maybe are you charging some things incorrectly and you need to fix that going forward? So with that, I think it comes up to our first polling question that Amy will start for everyone.
Okay, our first polling question here. What are 3 examples of an allowable cost?
All right, so looking at the results, 47% of you answered travel, relocation, and depreciation. That is correct. If we look at the other ones, B wasn't correct because donations aren't allowable. A wasn't correct because bad debt's not. And then D, if some of you answered D, that one's kind of a trick question. Lawn care, I would say, is generally not allowable. I'm trying to think of grants where lawn care would be necessary and reasonable. I'm sure some of you may have an example, but you know, I think for the purposes of this, the correct answer was C. All right, so now we're going to talk a little bit about payroll. Payroll is very tricky, and I would say probably harder for all the entities that have multiple grant awards. So if you have employees that work on multiple grants, or that you're held very strictly to a budget, so all the governments out there, payroll can be very difficult. This slide obviously uses, it has all the, this slide and the next slide has all the requirements in there. Some of these may seem obvious, like incorporated into official records. What does that mean? It's just part of your payroll expense. It's in your payroll register. It's not something that was somehow paid to somebody that's not part of your own organization's payments. But the key one on this slide is that your payroll records need to reasonably reflect the total activity for which the employee is compensated. It can't be over 100%. Some of you may be wondering, how do you have over 100%? And we have seen it happen before, where they have payroll records that say an employee works 40% on grant A, 40% on grant B, and 30% on grant C, and somehow there's a breakdown in communication between the departments or whichever, and then we're looking at a part where they have 110% spent on the different federal grants. The other really key piece here is that budget estimates do not qualify. So for the governments out there, this is a really big deal because everybody is constrained by their budget. And if their budget says that, you know, this FTE is 75% here and 25% here, and that's how they're going to be allocated from the payroll system and how their expense gets allocated, then that needs to be trued up and it has to be adjusted to actual. That can be a challenge. I know it's also a challenge for nonprofits when they're building their budgets for the different grants and they want to charge somebody's time 60% to one grant, 40% to another, and they're looking to maximize their reimbursement. Again, you can't just use a budget estimate. You are allowed to use one in the interim. You're allowed to use one up to 3 months. And then at the end of 3 months, you have to do a true up. So at least quarterly, there has to be a true up from budget to actual. So kind of summarizing everything from the previous few slides, I know we went over a lot of material. What do we normally find? What's the findings that we normally note? We normally note the time and effort tracking. And the reason is we see a lot of budget allocations. We see a lot of employees allocated based on budget, and there's no supplemental record that says, you know, Jane Doe spent 40% and 60% rather than 50-50 per the budget. So we see that issue a lot. Fringe benefits, they go all over the board. Fringe benefits need to be allocated in the same manner that the payroll is usually. And we have organizations that stay away from fringe benefits and don't charge any, and that's not a finding or question cost. You're just not maximizing your reimbursement. But then we also have organizations that charge all the fringe benefits, and they're not charging it in the same manner that the payroll expense is charged. I already talked about budget versus actual. And then if we think about, well, what's kind of the issue there? If we think about salaried employees and what are the internal controls on salaried employees, or you can think of exception reporters where they only report in their time card if they have time off or they're sick, something like that. Otherwise, they just get paid their, you know, their time card's just their straight 40. If they spend time on multiple grant activities, what type of review process is there? You know, normally they only have a time card if they're sick, but if they're spending their time spent on multiple grant activities, who's reviewing the allocation of the actual time spent? So think of supplemental time card records there. Looking at indirect costs, there's a lot of, you know, different common findings here, and I think the common basis really is either there's unallowable costs in either the cost allocation pool or in your modified total direct cost base that you're using. So those of you that are familiar with indirect costs, if you have unallowable costs in your base, then you're not calculating the rate correctly. And then the other big one is costs not being allocated in accordance with the cost allocation plan or the indirect cost rate plan, whichever your organization has, if applicable. You know, I know that the federal government normally reviews a lot of these cost allocation plans, but that's just reviewing the narrative at a high level. They rely on the auditors to make sure that the organizations are actually allocating their costs based on that plan narrative. And many times what we find is that plan narrative either isn't current or up to date, or it's missing, it's not complete for new information, or that there's just errors and the narrative says that they're going to be allocated based on a percentage of FTEs, but the cost is actually allocated based on square footage or something like that. And that's very, very common for those of you that have, you know, for the ones that are operating in a more complex environment with cost allocation. So thinking about prevention, if you have employees that spend time on multiple grants, I think it's really, really hard to come up with any prevention other than supplemental time cards. I know that most people don't like keeping track of their time, but that is really the easiest way to prevent payroll-related findings, is to have supplemental time cards where they're tracking their time spent on the various grants, and then obviously a true-up that's done quarterly to make sure that the grant is charged accurately. That is probably the #1 way to prevent a payroll finding. Training or references available for fringe benefits. I didn't spend any time on fringe benefits, and the reason is because they're very complicated and there's a lot of different ones, whether we're talking about pension or health benefits. time off, different types of leave like military leave, severance pay, all of that type of stuff, they all have different treatment. And so if you have fringe benefits, you need to look at the specific requirements in subpart E governing those. When we talk about indirect costs, monitoring changes to your cost allocation plan, making sure that it's current, looking and just making sure that it represents the current environment of your organization. A lot of these plans have been around for many years. Some of them may be 10, 15, 20 years old. And I'm guessing that your business operations have changed a little bit in the last 20 years. So that's key. Independent review, knowing where to look up allowability. Again, you don't need to memorize all the generic cost principles, but you do need to know that they're in subpart E of uniform guidance and where to find them. And then again, I said, like earlier in the presentation, designing and implementing internal controls to monitor compliance. So for allowable costs and allowable activities, what does that mean? That means that there's somebody reviewing the charge to the grant, whether it's a payroll charge, a direct good and service charge, or an indirect charge allocation. Somebody somewhere is reviewing that and looking, is it necessary and reasonable? Is it adequately documented? Are we applying it correctly? And are we, meeting all those standards that I kind of just talked about? So again, that's key. Hopefully allowable activities and allowable costs, there aren't any big surprises to anyone on the phone. If you have questions on any of this, again, please feel free to ask and I will do my best to answer them. Okay, moving on to cash management. Cash management, there's really two methods that everyone uses except for states. They're a little bit special because they have a Treasury state agreement for some really large programs like Medicaid, where funding works a little bit differently. But for most cases, there's two methods, advance and reimbursement. The advance method means that it's for immediate cash needs. We get questioned all the time. What does immediate cash needs mean? How do you define immediate cash needs? So I don't know. I haven't seen any like hard, fast rule other than I have seen the Department of Justice put out in their grant and financial guide. The Department of Justice defines immediate cash needs as 10 days. So some of you may be thinking, wow, we get our grant a month in advance to meet, costs for the whole month, or to meet payroll, or for cash flow issues, et cetera, et cetera. Department of Justice defines immediate cash needs as 10 days. Have I seen something similar to HHS? No, it depends on the different various grants. But I would say 10 days, that's 10 working days or 2 weeks. I think that's probably pretty realistic in today's environment with electronic fund transfers and how all of that works. Have I seen arguments for up to a month? If maybe, and that can maybe be reasonable depending on the situation. But those of you that are doing it 3 months or 6 months or a year in advance, that's definitely outside a reasonableness scope. So just keep that in mind. Reimbursement method. So that means that the costs are paid prior to the claim. And obviously we'll talk about the common finding that we see on a reimbursement method on the next slide and kind of go over on some details for that. For pass-through entities. So for those of you that are passing through funds to subrecipients, you also have a responsibility to ensure that the subrecipient is asking for payment or that you're funding them either on a reimbursement basis or for immediate cash needs. And I have a couple of clients that don't really want to go through the administrative burden of that. And if they have a subrecipient that's getting a small amount of money, let's just say it's a $10 million grant and the subrecipient has $10,000 of that, they have in the past given them the whole $10,000 for the whole year up front because it's not worth it to them to process a request every month or every 10 days to fund them. That's that's technically not allowable. So again, as a pass-through entity, you need to make sure that your subrecipients are also conforming to either immediate cash needs or a reimbursement method. So when we think of the common findings, I'll cover program income second, even though it's first on this slide. Drawing in advance of immediate cash needs or not on the reimbursement basis. So what happens is, for the immediate cash needs, drawdowns are based on estimated disbursements. We see that quite a lot where you have a pending transaction and it needs a supervisory approval, and the supervisor goes on vacation for a week and there's nobody to process that request, or maybe it doesn't actually make it through the check run, and that is charged to the grant either too early because it, the immediate it's not that immediate, or you thought it was paid, and so there's an issue on the reimbursement because it's still sitting as pending and not actually occurring. The other issue is the application of program income. We will talk about program income in detail coming up, but on the cash management side, if you're getting any revenue that is applied to the grant, you have to offset the, well, not, you don't always have to, but in the cases where you have to offset program income against your draw, sometimes that program income isn't being included into the reimbursement amount. So if you're asking for 100,000 and you have 20,000 in program income, you really should only be asking for 80,000 in that example, if that's the method of program income that you follow. So prevention, how do we stop drawing in advance of immediate cash needs, or how do we stop asking for funds that haven't been paid? You need to understand actual versus pending transaction, how your check run handles that, how your software treats that, how does that look like in your general ledger? Is it applicable to you? Maybe it's not. And then if you have program income, we're gonna talk about this more once we get to program income, but you do need to review the program income expenditure data as well as your general expenditure data. And again, we'll come back to program income in more detail. Okay, eligibility. So eligibility is different for each grant. I can't really, speak on the eligibility requirement differences between foster care versus temporary assistance for needy families versus, school lunch. Those are all very different programs. They have different eligibility requirements. But the key is that they can be broken down into either three categories. They can be beneficiaries, so individuals that are required to have certain eligibility. It can be to groups of individuals or areas of service, or it can be subrecipients. There are some grants that are required to be passed through to subrecipients, and there are requirements on what organizations can actually be a subrecipient. It varies from grant to grant, like I just said, but it is communicated in a number of different places, either in program legislation, in your terms and conditions of your federal award. There are communications on the eligibility requirements, so it is important to monitor those if you have a grant that has, especially it's most common if you have a grant with either beneficiaries or subrecipients. The group of individuals, area of service delivery is not as common, but if you have beneficiaries that you're making payments to or purchasing thing on behalf of, or subrecipients, you need to look closely to make sure you're following any eligibility requirements. So we have a polling question here that will split up the eligibility talk, and we'll talk about prevention for eligibility on the next slide. But first we'll answer polling question number 2, and Amy will pull that up for everyone.
Okay, polling question number 2. Budget estimates alone do not qualify, and if used, must be trued up after the fact to ensure the amount charged is accurate, allowable, and properly allocated. All right, that second poll is now open. We do have one question that came through.
Sure.
This goes around polling question number 1. So is there a de minimis for the invoices and receipts? The IRS is $75 that is allowable under federal awards.
Yeah, so is there a de minimis for the invoices or receipts? So I am guessing that is on document retention to support an allowable cost. There is no de minimis as far as federal awards go. So if you're charging a $50 invoice, we need to see the documentation for that. Now, there are paperless records, there are various different records, but you have to maintain some sort of supporting documentation for the auditor to test. So it's not like a tax situation with $75 and the IRS, you know, to approve, you know, like a tax audit under federal awards. You have to have support for all your transactions charged to the grant. Perfect. 97% of you answered that correctly, and the 4 that didn't, I'm sure the mouse just slipped and you accidentally selected false. So yes, again, budget estimates alone do not qualify, and they need to be trued up as far as payroll goes. Okay, so back to eligibility. The common findings that we see is that there's a lack of document retention, especially in the more organizations go to paperless, the more that they're not keeping those manual files anymore. Document retention is getting harder and harder, and I, you know, it used to be that it was hard to keep the documents in the actual paper file, but I think that's even more prevalent now with the paperless filing. Is you'll have a case file on XYZ, you know, on Jane Doe, and when we go to look at the records, it has maybe just the application in there, but it doesn't have any of the supporting documentation. So document retention is a really big issue. Complete information. I can't tell you how many times I've looked at an application to be eligible for an award that wasn't completely filled out. I know that sounds weird to you, but trust me, if there's a 5-page application that the participant has to fill out and they only fill out 3 pages, and your intake clerk or whoever's doing the application process doesn't actually review the application because they know the person's going to be eligible, and then the auditor comes around and there's 2 pages that are blank, that's going to be a finding because all the information wasn't obtained. The other one that pops up is required redeterminations. If you have a grant that you have to redetermine eligibility on an annual basis or a semi, you know, on different monthly bases, we need to be able to see that those redeterminations were performed. And again, that goes back to that document retention aspect, especially with the paperless systems now, that's getting really hard to see. So what are kind of some prevention tools that we could see prevent some of this? Some sort of case file checklist. That used to be a real big thing in the paper world, but it could still be a thing in the paperless world too. You can still have a checklist in the folder on whatever drive you're keeping the documents on, and do you have all of the files that are required? Independent review and approval. This one we could put for every single compliance requirement, but I want to point out or think about it in the terms of many of you probably operate on some sort of case management electronic software now, where it's all electronic records and you're putting in the data into the system, and then the system maybe automatically even determines eligibility based on their income or other, you know, demographic information. But ask yourself or look at it, who is reviewing the input into the system? So if that caseworker or that intake clerk, whoever you have, is inputting information into the system and nobody's double checking that it's getting entered based on either the application or other supporting records accurately, that's where errors occur, because then when we come and see that that person was deemed eligible by the system and we go look back to the supporting documentation and they don't match up, it's generally because nobody reviewed that input into the electronic system. And I'm happy that the electronic system can actually calculate eligibility correctly, but you have to have good information being input into it. termination notifications, some sort of calendar alert or something set up in your system that tells you when redeterminations are required. You know, eligibility again is unique to each grant. So designing and implementing internal controls, you have to make it function based on your software, the grant requirements, your organization, and how that impacts you all. All right, equipment and real property management. This one is not very common. We usually don't see this a whole lot. Unfortunately, when we do see it, we see a lot of findings in this area. So what equipment under federal awards means is it means tangible personal property that is that has a useful life of more than 1 year and an acquisition cost greater than $5,000 or your internal capitalization policy. So if your capitalization policy is $3 grand, then it'd be an acquisition cost of 3,000 or 5,000, whichever is lower. Real property under federal awards is land and buildings. So the state gets to just use their own acquisition and disposition laws and procedures. There's a couple of things where they get scoped in at, but generally the state follows their own rules. Everybody else, whether you're a local government, a nonprofit, a higher institution of higher education, all of you have to follow uniform guidance. And the overarching principles for equipment and real property is that the equipment purchased has to, or the real property has to be used for its purpose, for the grant purpose. You have to have records maintained. They have to be safeguarded. They have to be kept in working order, and you have to follow appropriate disposal instructions. So where do things run afoul? The really common finding is that the asset wasn't identified as a federal purchase. So this is common with larger governments where you have a finance department like the comptroller's office, and then you have a parks and rec department or a sheriff department and animal services, whichever. You have all these different departments, and maybe the lines of communication aren't as fantastic as they could be. And Parks and Rec buys something, it's charged to the federal award, but maybe the finance department or whoever who's maintaining the federal asset listing doesn't know that it was purchased with the federal award. Could be vice versa too, that the individuals at the Park and Rec department, got a vehicle and they had no idea it was charged to the federal grant. So we see the identification missing a lot. Why is that important? The reason it's important is because when your organization goes to dispose of assets, if that was a federal asset, they have to request instructions from the federal agency because the feds may or may not want money back. So if you're disposing of an asset and it's got no cost, it's not no big deal. But if it's getting disposed of in an auction or sold in any other way, the feds may want a portion of those proceeds back. So that's why there are disposal instructions that are required. And if you don't even identify the federal asset, then you're obviously going to miss the disposition side too, because you wouldn't have any idea that you were disposing of a federal asset. There is a requirement too of a physical inventory every 2 years. That does mean somebody going out, looking, noting it down that yes, it's still on property, it's still held with the organization. Also means that it's still maintained in good order as well. So those are really the 3 common findings, and we see number 1 and 2 up there all the time. It's very, very common. So how do we prevent that issue? Really, it's the implementation of either addition or disposition checklists, review for federal versus non-federal type things. It's all of these, and the training, all of these could really be lumped into increasing communication between all the parties involved of determining whether it's federal or non-federal. Really, that's the requirement is what kind of communication you have between everybody. All right, matching level of effort and earmarking. Again, unique to each grant. Matching is when the local entity has skin in the game. So here we're going to give you $100, but for every $100 we give you, you have to spend 10. Level of effort is really to make sure that you're supplementing your ongoing programs and you're not supplanting funds. So if you're running a program with 10 FTEs and now you get a federal award, you should have the 10 FTEs you originally had plus the extra 2 that the federal award is giving you. You're supplementing your program, not supplanting services. And then earmarking is really the feds talking about how to spend the money. And again, unique to every single grant. Where do we run into trouble? So for matching, it is double dipping. Again, that's where I'm required to spend $10 per every 100 I get on this federal award, and here I apply $10. You can't take that same $10 and apply it to a different federal award as match as well. You have to have unique costs to each federal award. We also have entities that use one federal award to act as match for another federal award. That's almost always not allowable. There are a couple of exceptions to that, usually in block grants where there can be some application, but that's communicated directly in the program legislation, and it will be very clear when that's allowable. If it's not clear, then it's 99% not allowable. Matching funds that aren't allowable. This is key because when you're saying here are these $10 towards that 100, they have to be an allowable expense, which also means that they needed to be procured using the same policies and procedures that you would for federal funds. So just because they're your local dollars, the fact that you're using them as match, they need to be used or purchased and procured just like a federal purchase would be. And the real issue with level of effort and earmarking is that there's a lack of monitoring and people don't really know of the requirements. So they didn't know they had to, pass through at least 10% to subrecipients, or admin was limited to 5%, or nobody's looking to see that admin was limited. It's really a budgetary issue a lot of times, where especially with level of effort, if you have to spend 90% of the prior year costs to make sure you're maintaining a certain level of effort and you only budget 85%, then right away you basically have no chance of being compliant. So there's a lack of monitoring there, but the prevention side is training on the requirements, to understand the requirements that the grant's imposing, to have an appropriate chart of accounts so that you can track where your matching funds are going and what grants are taking credit for the matching funds. That's important. And again, no matter what, it's designing and implementing those internal controls. So whichever works for the requirements of your grant, your organization, they're going to be different depending on the requirements. To look at how do we avoid double dipping, how do we monitor these requirements, those type of items. Period of performance. Period of performance is, it's actually, when we think of compliance requirements, it should be relatively straightforward. There's really only a couple of things to worry about. Period of performance is when obligations can be incurred under a federal award. Don't get confused with the liquidation date. So if the period of performance is July 1 through June 30th, that's when you can incur obligations, meaning that's when goods or services can be incurred underneath the grant. The liquidation date is that excess 90 days that you have after the grant period to actually pay all your liabilities. So liquidation is the payment of the obligations, but the obligation date is what's allowable under the federal award. The only other aspect that we run into is pre-award costs. Pre-award costs can be allowable if you have prior written permission. So again, my earlier example, let's say period of performance is 7/1 through June 30th, and we'll use 2019 as the example. If you're trying to charge something from fiscal year 18, then you would need prior written approval. And I'll just take that question now, Amy, that I saw pop up. Is it always 90 days? That's the default period, is 90 days. If your grantor is communicating something less than that, then you would need to follow the requirements that your grantor is imposing on you. So it could be less than 90 days, but 90 days is just the default of where the feds start at. But it won't exceed 90 days. So it'll be 90 days or less, depending if your grantor. Yeah, so some grantors and some may communicate that they want it within the grant period, and that's because they're trying to improve how quickly they close their own books on their side. And maybe they've had problems that if they allow subrecipients to take 2 months to pay costs, that they can't get their funds reimbursed from the feds within those 90 days, because they would have to pay the subrecipient and then get reimbursement. So depending on timeline, cash flow, and other factors, grantors may impose shorter restrictions. Yes, and obviously in payroll it becomes very difficult. So yeah, again, liquidation date at the federal levels is 90 days, but a grantor may impose for various reasons, and usually it has to do with they're trying to meet their own 90-day requirement or their own financial close requirement, and so they pass down a much shorter requirement to subrecipients. So common findings, well, there's really only 2 places for findings to occur in period of performance, and that's incurring obligations in the liquidation period. We see that a lot when there's unspent funds. So if you have a $100,000 grant award and you only spent $90,000, a lot of organizations get uncomfortable with leaving that $10,000 left on the table, and so they'll charge that and ask for reimbursement. But it was a subsequent obligation. It was a supplemental good and service that was obtained. That's really probably the most common finding that we'll see. And then the other one is charging a pre-award cost without approval. That one we generally don't see as much. Normally it's the one that they had unspent funds at the end and they're trying to spend all the money, and so they're incurring some goods and services in FY20, for example, that they're still charging to the FY19 grant. So the prevention here, hopefully these are relatively obvious. It should be independent review and approval. Somebody's reviewing the charge to make sure that it was incurred, that the obligation was incurred within the period of performance. Okay, procurement, suspension, and debarment. Probably the #1 finding area. This one and subrecipient monitoring are probably tied. They have the most findings. They have the most complex requirements. They also have the most difficult from an administrative standpoint of having the resources to carry out these requirements. And I think that's probably why they're the most common finding. So procurement, suspension, and debarment. What is the general rule? The general rule is organizations have to follow their own procurement policies, but the procurement policy has to be compliant with federal and or state and or local, I didn't put local, but and or local laws and ordinances. So maybe for the nonprofits listening, they don't have too many concerns with the state law piece, and they're really just concerned with the federal law piece. But for the governments listening, every state has a local government statute that governs purchasing. They don't let local governments just do whatever they want. I haven't seen one yet where I've seen that. There's either contracting statutes or bidding statutes, quotes, et cetera, et cetera. Your policies, you have to use your policies, and then they have to be compliant with federal and state. They can be stricter, they just can't be less strict. The overall requirements are that there's informal quotes for small acquisitions. So the federal guidance lists small acquisitions as between $3,500 and $150,000. That top threshold comes down usually in a lot of state laws. I know in Nevada, for example, depending on the type of purchase, it's $50,000 or $100,000 if it's public works. Other state laws are probably similar. You may also have, if you're a nonprofit, maybe your board is uncomfortable with a $150,000 limit and they've set a limit of 25 or 50,000 for a small acquisition. So no matter what, you have to follow your policy, which is hopefully compliant, but it can't, your small acquisition can't exceed 150,000. Once it exceeds the small acquisition, so we call that the simplified acquisition threshold, again, currently 150,000, then formal competitive bidding is required. Now, there's lots of different types of formal competitive bidding, and organizations get very hung up in the terminology and the language. What do we mean by competitive bidding? Competitive bidding can be sealed bids. That's common with public works. It can be an RFP, or a request for proposal. That's very common with professional services. It can be an RFQ, which is a request for qualifications. That's what's required in design and engineering. What we mean by competitive bidding is what formal solicitation process was followed. You know, a lot of clients will say, well, that wasn't public works, we didn't have to go out to bid. And that's not what we're asking. We're asking, okay, well, what was your RFP process? What was your RFQ process? What was your formal solicitation? Now, there are exemptions to formal solicitation and non-competitive purchases. There are only 4 under uniform guidance. I'll use an example just because I'm familiar with it. In the state of Nevada, there are over 20 exclusions from competitive bidding. So that $50,000 requirement is applicable for formal solicitation for RFPs, but there are a bunch of exclusions that are in excess of the federal exclusions. Unfortunately, if the procurement is being charged to the federal award, we have to follow the federal exclusions. We can't include those other exclusions because they're not compliant with the federal law. So the federal exclusions are sole source. It's an emergency situation, meaning that there's public health risks at, online, and we can't wait to go bid something. There's a flood coming and we need to get culverts built and we need flood prevention, and there's an emergency situation. You can have prior written approval. If you don't want to procure something competitively for whatever reason, administrative burden or something else, you can ask your grantor to approve a non-competitive purchase. Or you went out to bid and you didn't receive any responses, or you only had one response, right? So that would also be an allowable non-competitive purchase. There's also required contract provisions. I don't know if I've seen an organization yet that had all of the required contract provisions. Many of them are very generic and people don't think they make sense. For example, every contract over $150,000 that's charged to a federal award has to have the Clean Air and Water Pollution Act provisions in it. Now, if you're entering into a professional services contract for consulting work, it seems a little ridiculous to have clean air and water pollution in the provision, but that is a required contract provision. Suspension and debarment, that's the other another requirement, and that is, what are you doing to make sure that the entity you're contracting with is not suspended or debarred from federal funds? There's 3 ways to check it. You can do an independent check on the excluded party list system, which is at sam.gov. You can have a contract provision, or you can get a certification from the entity that they're not suspended or debarred. This also applies to subrecipients. So we'll talk about subrecipient monitoring, but it does apply to subrecipients as well. So what are our common findings? It's basically the inverse of everything I just talked about. There's a lack of written policies and procedures, or they have policies and procedures, but they're not compliant with federal and state law. There's a lack of maintaining quotes. conflicts of interest weren't documented, the history of procurement wasn't adequately documented, contract provisions weren't all inclusive, there's an inappropriate purchase method. So for example, let's say you have to go out to bid at $150,000 and you structure the transaction so you have two separate transactions at $120,000 so that you avoid that $150,000 threshold. That would be called structuring, and that's also not allowable. Inappropriate factors impacting competition. Again, it's competitive bidding. It's meant to be fair and open competition. So what are some factors that we see that limit that competition and cause a finding? Geographical preferences, soliciting from a pre-approved list only. A pre-approved list is okay. You're more than welcome to use that. You just have to have that pre-approved list to be open to let others enter it. This is very common in the engineering contracts where you have public works that wants to get something fixed on a road or a street or something like that, and they send a scope of work to 2 or 3 different engineering firms in town, and they just go that method. That's not allowable if they haven't opened up that list and made it full and open competition, if it's requiring formal bidding. That's okay if they're asking for informal quotes, because you only need a minimum of 3 quotes. Inaccurate descriptions, unnecessary experience, inappropriate use of sole source. That one's very common too. Everybody likes to say something sole source. There's very few things that are actually sole source. If it's something that's very custom that only one vendor can make or provide, that's what sole source is. It's not that you've only been working with one entity and it's very quick and easy with that vendor, and so that's sole source because we don't have another approved vendor, because we haven't gone through the administrative process yet. If there's other vendors in town that provide the same good, then that's not sole source. Suspension and debarment was not verified, or at least not documented. We have a hard time with that when clients say, well, the party's not suspended or debarred, and then we ask, well, can you show us where you checked that? And then they print off something from that day. It's not that day that we're asking, it's prior to the entering into the contract that we need to verify that you checked the party wasn't suspended or debarred. Purchasing alliances, also very common. Remember, at the end of the day, the organization is the responsible party. If you've entered into some sort of co-op agreement or purchasing alliance and others do contracting for you, you still need to make sure that they were aware that it was going to be charged to a federal award, that it was still open competition, and that federal procurement was still followed. You don't have to actually carry out all of those, but you need to do some due diligence to make sure that it was performed. And I already talked about a lot of the prevention side. Training is very key. You need to have lots of layers of review, especially on the authorization to purchase, not necessarily for just the approval at the very end. So again, you need to authorize somebody to actually purchase something, so you're seeing the bidding and you're seeing the quotes. After it's already been purchased, that's too late, because if the bid wasn't followed, that's after the compliance piece for this requirement. Okay, that brings us up to polling question number 3, and Amy will bring that up in just 1 second.
All right, polling question number 3. Equipment, including IT, can be considered tangible personal property.
All right, 86% said yes, and that is true. Under a federal award, equipment, including IT, is what is considered tangible personal property, assuming that it's over $5,000 and has the useful life of a year. So if you answered not sure because we didn't give you that information, then you're technically correct as well. Okay, we're going to go over program income and reporting very quickly because I want to get to subrecipient monitoring before we run out of time. Program income, for those of you who don't know what it is, it's when you earn income as a direct result of running the federal program. So it's very common with HHS grants where they have some sort of clinical grant that they're charging fees for, and they're obviously very reduced fees, or on any grants that give out loans. So some HUD grants where you get a grant from the state, or the state gets the grant, but then they're loaning some HUD dollars out. There's interest income on those loans. Again, that's what program income is. There's 3 ways to apply it, and it depends on the federal grant guidance. You can either deduct it from your future draws. So that's my example earlier where you had $100,000 to get reimbursed, but you had $20,000 of program income. So you're really only asking for 80 because your program income offset the other 20. It can be in addition to. So instead of 80, you have to spend 120 because you're asking for the 100, but then you also need to spend that 20,000 in income that was generated on the program. Or it can be used as cost sharing or matching, and used as spent for local sources that are counting towards their match requirement. And again, I know I'm going to go through program income and reporting quickly, but that's because subrecipient monitoring is very important. The findings that we see is generally when entities don't know they are generating federal program income, so they're not applying it to the grant correctly. You may ask, how does that happen? There's quite a few instances where entities may not be thinking about fees that are being generated as a result of the program, that those should be applied to the federal program. So the prevention side, again, is obtaining clarification from your grantor on what may or may not be program income, and then how to apply that. Reporting, there's different types of reports. There's financial reports, special reports, and performance reports. In general, what the auditors and what the feds are looking for is that they're prepared accurately and in accordance with the instructions, and that they're supported by appropriate documentation. So what do you think the common finding is? It's, well, that supporting records weren't maintained, or that the reports are inaccurate. There is one up here that may surprise some of you, and that's verifying that pre-populated numbers are accurate. There are a lot of federal reports now where the feds are pre-populating prior numbers on a cumulative report, and sometimes those are wrong. What we look for is that there's some sort of communication where you have notified the grantor that the pre-populated numbers are inaccurate. You know, you can't fix some of those in many cases because they are pre-populated, but you should be working to get that resolved or fixed. What's the prevention side? Review and approval. If somebody is actually doing the review, they will catch 99.9% of these errors because they'll see when things don't reconcile. That's exactly what we do during the audit, and if we see something doesn't reconcile, that's where the finding occurs. Okay, I want to spend the last part of the presentation really talking about subrecipient monitoring. It is equal with procurement as far as the consternation that it causes clients. It can be very difficult to monitor all your subrecipients, especially for the larger entities that have a lot of subrecipients. So the state entities struggle quite a bit with subrecipient monitoring. It can be broken into 3 areas. There's pre-award requirements. So that's the elements that are required on the subaward. There's during the award, so ongoing, if during the year, what monitoring requirements are there? And then there's post-award, so after the award is closed, what monitoring requirements are there? And essentially, pre-award is subaward requirements. During the award is on-site reviews, desk reviews, reviewing reimbursement requests, other documentation. It's the active, ongoing monitoring. It is not just sitting back in the office and approving reimbursement requests. It's more active than that. There's risk assessment, there's on-site, there's desk reviews. It's a much more active process, or at least it should be. than just approving reimbursement requests. And then the post-award requirements are making sure that the subrecipients obtained a single audit if they were required. It's monitoring the findings and issuing management decisions. Management decisions are also required on any like on-site reviews and items that you're giving as well. But the big piece is in that single audit review report, that if you see a subrecipient that has a finding, you need to be issuing a management decision on their corrective action. So what are the common findings? There's I think 21 requirements for subawards under uniform guidance as far as information that's required to be on them. That is usually woefully incomplete. There's no risk assessment policies or procedures, or if there are, they're not followed through. And what that is if you have subrecipients, you need to have policies that are going to dictate how much monitoring is required. And how often is an on-site review required? When's a desk review required? How many reports are you going to look at? You know, sometimes 100% isn't possible, and you need to sample. So what does that look like? Lack of review of subrecipient audit reports, lack of issuing those management decisions, and then the suspension and debarment verification. Governments and nonprofits, it's not just contractors, can be suspended or debarred from federal funds. There was a few years ago a health district in New Jersey that was temporarily suspended from receiving HHS funds because they weren't ADA compliant, and the feds had gotten tired of them not being ADA compliant for 20 years and said, well, until you comply with the Disability Act, we're not going to let you receive any federal funds. So they were temporarily suspended, and that was a governmental unit. So you do need to check suspension and debarment for subrecipients as well. Prevention, there is a ton of training that is needed for subrecipient monitoring, not only for your actual subrecipients, but also for your staff who are carrying out the training. You know, usually I've done some of these trainings for clients and they take a whole day. So literally an entire day just to talk about subrecipient monitoring. It's not something that we can, you know, get into the nitty gritty on in 10 minutes. It's a full 8-hour session on how to carry out effective subrecipient monitoring. But you do need to have policies. You do need to retain evidence of your monitoring. Should hopefully have a calendar that shows how often you're monitoring all your subrecipients. Assignment of responsibilities is big, especially for, you know, every grant has a fiscal piece and a grant piece, and maybe who's doing the monitoring for the financial aspect has nothing to do with or doesn't know about all the grant programmatic objectives, and maybe vice versa. So maybe there needs to be some assignment of responsibilities for who's monitoring what. And all of that really builds into an internal control system. Again, subrecipient monitoring is not something that we can, you know, cover in any great detail in 10 minutes. It's a full day of training, but just be aware of those common findings. And if you think that you're woefully behind on subrecipient monitoring, email me for additional clarification on stuff, and we can certainly talk about it. So that brings us to polling question number 4. And then there's one final slide before questions, and we'll try to answer questions directly after that.
All right, so polling question number 4. The requirements of subrecipient monitoring can generally be broken into 3 areas, true or false.
Perfect. 89% of you said true. And yes, that is true. There's pre-award, during the award, and after the award monitoring. That's the easiest way to organize it into the 3 different areas. Okay, lastly, real quick before questions on special tests, this there's no real common prevention or finding here because special tests are different for every single grant. The key is understanding what they are, implement the training on the requirements as appropriate, and then depending on what the requirement is, implement those internal controls. Okay, so with that, I think we've got quite a few questions in the queue, and I'll just start taking them, Amy. And then
Okay.
I guess if any of you can't stick on the line to hear the questions, feel free to send me emails or call or ask for additional clarification. I'll be happy to respond.
Okay. So the first question here, isn't small accusation now 10,000 and not 3,500?
Yeah, so here's what happened is OMB or the feds made a little bit of a boo-boo. They sent out that OMB memo M1818, and when people read that memo, they thought that gave a waiver to allow for the early implementation of the NDAA 2017 thresholds. And what that memo was later clarified said was that that was a memo to federal agencies to allow them to grant a waiver to entities who requested it at their discretion. So it was, if you're an entity with HHS dollars, you could ask HHS to grant you a waiver, but it wasn't an automatic waiver to the individual organizations. So what NDAA did is it raised the threshold to 10,250 instead of 3,500 and 150. But that waiver was to federal agencies. And so they later clarified and said, now we've issued another waiver that if you inadvertently used that original memo as evidence to move to 10,000 and 250, that's okay as long as you documented that election of that waiver at the time. We'll let it go, but it was never meant for that. So if you haven't moved it, then you're back still at that 35 and 150 realm. It's very complicated. If you have that situation, please email me or call me and we'll talk about it in detail, because that mix-up is very complicated.
Okay. Isn't the simplification accusation threshold now 250,000 instead of in 2019?
Yeah, same answer as that previous
Okay.
question. Is OMB made a mistake with that additional waiver?
Okay, and that's the same question again. Okay, I have a federal award that has a period of performance of January 1st through December 31st, but cannot issue a request for reimbursement until next year for the last period of the grant. Yet this is a recurring grant that runs every year. How do you suggest we determine how to report this? Right.
So when you're submitting, if I'm understanding the question correctly, is you're submitting the reimbursement request during the subsequent year for the last quarter, and that is okay because your underlying obligations occurred during the period of performance. The second piece is your cash flow and when you receive funding for it, and that's kind of a separate issue with you and the grantor, but the costs are still allowable as long as the obligations were incurred in the correct time period. I'm thinking that's what you meant. So that's still allowed. It's just it's a cash flow concern.
I may have missed it, but is there a requirement to check for any vendor for disbarment, or is it only for contracted service vendors?
That's a great question. So really it's for purchases over $25,000. I will tell you that auditors really only look for contracts over 25,000, but how you design your internal policies and procedures, it's not a bad idea for purchases over 25,000. If, let's say you didn't enter into a contract for whatever reason, then you still may want to check that. If it's for some sort of commodity item that's not contracted, you're probably okay, but we generally look for contracts in excess of 25,000.
Okay, that is all the questions that I have.
Perfect. Only 1 minute late on the questions. Like I said, if any of you have any additional questions or I didn't answer it fully, or you think of something, please feel free to email me. Amy, if you go to the last slide, I think my contact information again is repeated on the last slide. please feel free, and thank you all for joining us.
Awesome. Thank you so much. Have a good night.